morning, everyone. Mike Paciotti, iCM's Chief Investment Officer, back again for this week's Markets in a Minute. Now, a bunch to talk about this week. Economics were back in focus with CPI and PPI releases, what they mean for both stocks and bonds. The answer might actually surprise you a bit there, along with Kevin Warsh taking the reins at the Fed. So let's just get right into it. This past week brought hotter than expected CPI and PPI data. Starting with CPI, headline inflation came in at plus 0.6 month over month, matching expectations, but still a very hot number. Energy contributed 27 basis points and core services another 30 basis points, really telling most of the story there. Energy was largely driven by, no surprise, oil prices, which accounted for 21 basis points of the increase. On the service side, shelter, particularly owner's equivalent rent, was the key driver there. Now, one silver lining was that much of the shelter increase appeared mechanical. Because of the government shutdown in October, the BLS compared housing prices to the April 2025 base rather than the typical October base. So a little bit of a mechanical issue there. Core CPI also came in a touch hot, plus 0.4 versus 0.3 expected, again, led primarily by shelter. Now, PPI. A scorcher here, folks, rising 1.4% month over month versus 0.5 expected. Once again, services and energy driving that move, with final demand trade services contributing 50 basis points, energy another 40 basis points. Now, final demand trade services essentially measure the spread between the selling price and the acquisition cost. So if businesses are selling against older inventory, purchased at lower costs, while expecting future input prices to rise, margins look like they're expanding, albeit temporarily. Now, the takeaway is that intermediaries are actually expecting higher prices ahead due to fuel costs and tariffs and the like. Now, in response, Treasury yields moved higher across the week by roughly 15 basis points over the entirety of the curve. Long bonds starting to look a little interesting here, folks. Now, markets are now pricing in nearly one full rate hike by next year. Rising rates, of course, generally negative for both stocks and bonds, as we saw in 2022. But based on current yields and curve structure, the S&P 500 should actually trade closer to 23 times trailing 10-year earnings on the Shiller PE. Instead, it's trading at nearly 43 times, implying that either yields need to fall significantly or equity valuations are simply too high for this rate environment, something particularly troublesome for the frothier segments of the market. Now, ironically, a Fed rate hike sooner rather than later could flatten the curve and potentially help equities by pulling long-term yields lower as short-term yields rise. So with Kevin Warsh taking over the Fed, he'd probably do himself some good by coming out of the gates tough on inflation. That's it for this week, folks. Quiet economic calendar ahead, but keep an eye on NVIDIA earnings Wednesday. Next week, I'll be turning it over to our Director of Investments, Ryan Lehman. Have a great summer, everyone, and we'll see you in the fall.